2025 have so far been an amazing year for the stock market. In fact, it's our third year of positive 10% plus annual return 3 years in a row, which normally does not happen very often. And when it tends to happen, where we get 3, maybe 4 years maximum in a row, sometimes 5, but 5 is rare, as you could see here, we tend to have something bad happen the year after, or we tend to have certain rotations. So what I'm looking for whenever I'm looking at 2026, I'm looking at stocks and sectors that have underperformed in 2025 and even in 2024. Because whenever you have a sector that underperforms for a year, 2 year, it tends to eventually become the outperformer, and then the outperformer could potentially become the underperformer in the year after. It doesn't happen very often, but it happens most of the time, where we had, for example, the energy stocks. They massively outperformed in 2021, 2022, and they recently been underperforming, and then a lot of the AI stocks and tech in general has been massively outperforming. Now, when I'm looking at this chart, which is mainly showing me a lot of the sectors returns over the last year, I'm seeing healthcare. Healthcare has been extremely hated this year, and I would not be surprised if healthcare does extremely well next year. And I own United Health, and I bought call options on it also, so I have exposure to that. We can see the staples, non-consumer, so a lot of boring stuff again, non-AI. They actually went down a lot this year, and that could be presenting an opportunity, especially if you're heavily invested in tech. And the last one, which I'm going to talk about today, is mainly energy. Energy to me is extremely, extremely interesting, and this is something that I have played 2 times so far, and each time I played the energy trade, I have made between 200 to 300% on a lot of the investments that I made in the energy space. And I'm going to talk about energy today. Now, if you look at crude oil in general, so crude oil chart over the last 5 years, crude oil has stopped around $115, and since then it's been in a structural bear market. It's been declining steadily, and now we're sitting at $63 per barrel. $63 in general, I believe, is very, very cheap. Now, in terms of a survey that I looked at, and this is a survey from the Federal Reserve Bank of Dallas. They asked over 200 companies, oil and gas companies, and they asked them, what kind of WTI price would you need to pretty much, you can't cover expenses and you would have to shut off the well. Now, if you look at the Permian, which is where most of the US oil production is coming from, their break even or their shut-in price is around $33 to $35 per barrel. And the other regions, which is not Eagle Ford is the smallest one in terms of production, it's between $41 to $45 per barrel. So for the existing well, we could say that the break even for them, let's say on average, is around $40 per barrel. Okay, now we look at the new wells, the break even for the new wells, which is very important from the whole narrative of drill baby drill and increasing production. For the break even of new wells in the Permian, it's around $62 to $61 per share, and it could go as high as $70 per share. So we can say $63 per share on average. Now, if you look at the price of crude oil, now we're entering the range of the upper end for the break even on the new wells, which is $63. And then you have the bottom, which I believe is the break even for the existing wells, which is around $40 per barrel. Now, why would that be a floor? Well, generally speaking, for a country like the United States, they want to, and especially Donald Trump even did that in 2016, 2017, they want to maintain an oil price where a lot of the majors, they're not like making a killing, but they're making some money. And that price has to be above the break even. So if the break even for the existing well is $40 and for the new well is $62, there has to be a floor, in my opinion, somewhere close to the $50 range. Now, if I'm right on the $50 floor to $55 floor in terms of the government, and oil right now is sitting at $63 per barrel, I believe we're entering a good range where it could potentially be very interesting to start accumulating a lot of those oil stocks as they've been declining since 2022 and since 2021 mainly. And I'm going to talk about some of them today. And I believe, again, we're entering a range where it could be a good time to start buying into them. And this is what I'm doing in my portfolio. Now, in terms of Saudi Aramco, which is the biggest oil company in the world, the stock has been crashing like never before. It's down 14% over the last year. It's down 21% over the last few years. And this is, again, Saudi Aramco, which is the biggest one. Now, something that's very interesting from Saudi Aramco is they have a very low break-even rate. So if you look at their break-even rate, it's only $21. It's one of the lowest pretty much oil producer in the world in terms of cost. Only a $21 price is needed for them to be break-even. Okay, but to sustain the dividend, dividend is very important because a lot of the budget of the Saudi government comes from the Aramco dividend. They need $77 for them to be able to maintain this dividend. And crude oil right now, again, is sitting around $63 per barrel. So there's not only going to be a floor from the United States, eventually there's going to have to be a floor from some of the OPEC nations. Now, if I use some ChatGPT for some help, around 30% of the Saudi's government total revenue comes just from the Aramco dividend. And Saudi Aramco has been raising the dividend every single year. They might potentially have to cut it this time around because they will not be able to maintain it. They will need around $77 per barrel to maintain it. And now crude is sitting at 63. Okay, and this is, to me, is very, very interesting. And I'm going to talk about the subject a little bit more. Now, OPEC on Monday has decided to increase production, a principle to increase production. And the funny thing is that oil actually went up on the news, and we've been going up since Monday in terms of WTI. So a lot of the bears, they were expecting oil to go down because they're going to increase production, but this opposite happened, and oil has been going up. And normally this is a good sign of strength whenever something goes up on what people believe bad news. It could be that some of the bad news is potentially priced in. But I read a lot of reports on the energy space, and I've been following a lot of smart people. And based on my understanding, most of the OPEC nations are pretty close to capacity, like they're very close to their ceiling level, where they can't really increase production beyond that. So we have a situation where OPEC is approaching their ceiling in terms of how much can increase production. And we have less investment in the United States, where production is expected to decrease in 2026. So we're having potential lower supply, but with the combination of lower supply, we could potentially have much more demand in 2026 as the federal banks around the world, central banks, they've been cutting interest rates at a record pace. We had over 15 cuts in May alone, and this is where interest rates stand, and they're going to eventually be going lower. And to me, maybe now in the near term, it's a little bit bearish. We have some unemployment, but ultimately, mid to late 2026, some of the rate cuts will start stimulating the economy, especially if a lot of the central bankers start doing quantitative easing, and this is going to stimulate demand in a major way. And you combine a potential surge in demand with a potential tighter supply, I think we could have a very good setup in terms of crude oil, where it's now sitting around $63 per barrel. Another thing that could push up a lot of demand is the strategic petroleum reserve in the United States, which got depleted way down, and they're going to have to fill it back up. It's going to take some time, but this is some more demand that could potentially come on the market. Now, there's one ratio that I'm going to share with you, which has been very accurate throughout the years, and I'm not sure how accurate it's going to be this time, but this is something called the gold to oil ratio, which is a very important indicator. And I simplified it where I took gold and I divided it by US oil, and this is oil here. So the yellow one is oil, and the white one is gold divided by oil to get the gold to oil ratio. Okay? Now, if you look at this chart, anytime the gold to oil ratio goes above 30, we tend to have a massive rally in crude oil. It first happened in the 1970s, where the ratio went above 30. We had a 2,000% rally in crude. Then it happened again in 86, and it went above 30. We had a 300% rally in crude. Then it hasn't occurred until 2016, where it spiked above 30. Then we had a 120% rally in crude from trough to peak. And then it happened again in March 2020, but this time it blew out way above 30. And then we had a 540% rally in crude, and now it has crossed and it's happening again and it's going ballistic because the price of gold is increasing a lot, but the price of oil is not following the price of gold. Now that may be a weird indicator, but it has proven to work. And one reason why it could potentially work is because whenever you have a much higher gold price, you have an increase in mining activity, which means an increase in oil and diesel consumption, which also brings in more demand for crude oil. But also it's because gold is going up and it's mainly signaling inflation. And it's hard to have a potential future with higher inflation. And crude oil is sitting at $62 per barrel. So this is another very interesting setup in my opinion. And again, the ratio has blown past 30. And this ratio is not good for timing the bottom, but it's a ratio that's telling us that this is potentially a good time to be potentially again accumulating some of the oil and gas stocks while they're cheap and while crude is sitting at $62 per barrel. Now, I have to be clear, I don't believe my thesis is going to play out soon. I believe I'm a little bit early and it will most likely take into early to mid 2026. But I normally don't like to time the market and I like to start positions and slowly average into them. So this is what I decided to do in this case. And there's one final chart I want to show you, which is mainly XOP, which is the oil and gas exploration ETF. And this is, again, a good indicator. What if it sells off for some kind of a recessionary reasons or economic weakness? It sold off 63% in 2008. Then we went up 128%. Then it sold off 57% in COVID. Then it went up to 188%. Now, over the last 12 months, it went down 27%. After that, I don't know what's going to happen, but I believe something major has to happen for a lot of those oil and gas stocks, especially that a lot of them are actually well capitalized and they have a good dividend, they're doing buybacks, and they have a good balance sheet, and they have low break evens in the mid to low 40s. And I don't believe the government is going to let it get there. So I think, to me, this is, again, a very interesting setup. Now, there's a lot of them that could be interesting in terms of investments. I like the majors. Chevron is good. I think Exxon is good. Occidental, which is owned mostly by Warren Buffett. And a lot of you guys that watch my channel like Occidental, maybe own it, and you asked me about it before. There's also XLE for a lot of people that like ETFs. If you're trying to potentially own some exposure to oil, as it gives you an inflation kind of hedge, it gives you a potential geopolitical hedge where if something happens, something crazy, that's good for a lot of the oil and gas stocks, and it's good to diversify a little bit away from tech, in my opinion. But for me personally, I like the royalty companies, and there's one royalty stock that I've been in and out for many years. It's kind of predictable, and I started buying it recently, and my plan is to dollar cost average and build my position by late 2025. And I think this is going to be a 2026 story when all the recession fears are over and the Fed hopefully lowered interest rates and the economy stimulates again and we have housing activity again and things starts getting better. I believe oil could potentially be much, much higher. But even if it wasn't higher and it was at least sustaining in the 70s, a lot of those oil and gas stocks could do well regardless of where oil is. And oil, again, doesn't have to go to $300 or $100. It could even sustain itself. And a lot of them are offering good opportunities. So I hope you enjoyed today's video. If you want to find out a little bit more about what I do when I'm buying something, what I'm selling, I share everything I do in details in my group. And this is the link if you're interested. But thank you again. Not financial advice. Do your own research. And I'll talk to you in another update.